Good morning. Welcome to Daily Rates Live with the Mortgage Calculator. Today we're going to be going over some live mortgage rates and then we're going to do a deep dive into fix and flip properties. This is a topic that's requested a lot. A lot of people love the idea, at least, of fix and flips. And so we'll do a deep dive into that here shortly. Go ahead and drop a comment there in the chat as you tune in. We appreciate it. You can also drop any comments in the chat, any questions you have in the chat as we go through here and talk about fix and flip loans today. Hope everybody's been having a great week so far. And it looks like we're live on all the different platforms, so we will go ahead and get it started. We'll take the chat off the screen for now, but keep dropping comments there in the chat. Drop any questions you have in the chat, and we'll get it going. All right, so welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender, and what we do every morning on this show at 11 a.m. Eastern is go through our actual live mortgage rates, and then we do a deep dive into a different loan topic. And today's topic is going to be fix and flip loans. So our sales manager, Jose, with 28 years of experience as both a loan officer and a realtor, has been on both sides of fix and flip loans. So he'll give us a nice rundown of fix and flip loans. But before we do that, we will do what we do every morning, which is pull up our pricing tool. So Nick, if you're ready, let's go ahead and pull up today's pricing and see what the market is looking like this morning.
All right, let me switch the screen and we will check it out. So as Kyle mentioned, this is our pricing tool that we go over every day. This will show us the general rates and the APR for today. It is March 7th, just after 11 a.m. Eastern, so all of our standard programs are live here. If you'd like a full breakdown of all of the itemized fees that go into the APR, a full loan estimate, please get with our team members. We have over 300 loan officers to help you out. For our demo, as we do every day, we'll set up a basic scenario and compare across the programs. So we'll set up a $400,000 loan amount. We'll set the LTV to 80% loan, 20% down payment. And we'll ask the computer to find the lowest rates we can offer for conforming conventional. We'll compare that with FHA, which is usually the second option for most borrowers. And then we'll check out expanded guidelines, also known as non-QM, where we have over 5,000 additional options beyond the standard here. We also have VA and USDA. VA is only for eligible vets and active service members. If you are, just let us know. USDA is only for eligible properties. If you happen to be looking there, just let us know. We'll start with conforming conventional. We'll do purchase, 30-year fixed, standard loan, primary occupancy, single-family home, 1 unit, state of Florida, county of Miami-Dade. And for all the demos here, we use an estimated credit score of 760 and an estimated debt-to-income ratio here of 40%. So with these settings, as we do every morning, let's check it out. I believe that's the same as it was yesterday, roughly. 6.375 rate. 2.5 discount points and costs, push the final APR to 6.672 here for our conventional option. So a great option for our borrowers that qualify conventional. Now, if there's any reason where our borrowers do not, typically the next option we want to present is an FHA option. So we'll set up the same exact scenario so that we can compare apples to apples here. And this time we'll select FHA. So FHA does allow more leniency on credit issues as well as a higher debt to income. However, we'll keep everything identical so we can compare apples to apples here and compare the APR. And again, it's about the same as it was yesterday. 5.625 rate, 2.375 discount points and costs. Put the final APR at 6.558. So as usual, FHA just a touch lower than conventional here in this example. So our customers that qualify for both, definitely check it out. And our customers that need to use FHA, this APR does include the upfront and yearly mortgage insurance. And as you can see, it's just a touch cheaper than conventional. So around the same cost or cheaper means that our customers that need to use this, it's definitely a great option for them. Now, where we love to specialize is if our customer unfortunately doesn't qualify for either conventional or FHA. Most other banks or lenders have to deny that customer. That's where we have over 5,000 additional options here under expanded guidelines using alternative income. So everything will stay identical, but now we have a new option where we can change the income type. So full doc is what we use for FHA, and conventional, that's 2 years of tax returns. So if we don't qualify with 2 years of tax returns, we will check out one of these alternatives. We have asset related, business bank statement. The investor programs are just for investment properties. We'll pull those up in a minute. Personal bank statement 12-month is the most popular program for a primary home here. So that's what we use for the demo. And then we also have RSU, stated, VOE, 1099, P&L, no income, CDFI, all kinds of variations here. But for the demo, we'll always select our 12-month bank statement, and that's for our self-employed borrowers. When our self-employed borrowers submit 2 years of tax returns, often they have write-offs and may not qualify at all, or just may need a little bit more income. Either way, we can help them out. No tax returns at all, just their last 12 bank statements. And we'll determine a debt-to-income ratio of 40% in our example here, using just their cash on the bank statements, no tax returns at all. So most of our self-employed borrowers qualify for much more income using these methods. So let's check out the bank statements today. All right, so we got some good options. And again, quite a few of these programs dropped rates, right? They were all over 7.4 last week, and they only update about once a week. So now they're all under 7.4 here for our top 5 options, which is awesome. Best option today, 6.875 rate, 2.425 discount points in cost, puts the final APR at 7.282. So notice we're within about a half a point there of conventional. So great option for our borrowers that need to use these alternative programs. They're just a little bit more expensive. So definitely a good option for our borrowers out there. Now, if we scroll down, some of our borrowers that need a little bit more help may need some of these options of these hundreds of variations that allow bankruptcies, foreclosures, other credit events at slightly higher rates and costs, as well as some of these other programs may allow different ways to calculate the income. So hundreds of options. Please get with our team to find the best ones. And for our final demos, we always want to do live pricing for investors. So investment properties here. And we'll set up the same scenario, 80% loan, 20% down payment. We'll find the lowest rates we can offer for conforming conventional, and then we'll compare that to our non-QM expanded guidelines. The government programs, FHA, VA, USDA, do not work for investments, so we stick with these 2 here for our final 2 demos. So the first one will be conforming conventional. Everything will stay the same as all our demos. All we've changed here is the occupancy to investment. And it's about the same as it was yesterday. So we're closing the gap here, very close. Our portfolio option here at the top, remember, is not a true conventional option. It uses all the same guidelines, but it's not a Fannie or Freddie loan. So this option is technically the same guidelines, just doesn't need the loan level price adjustments, which is why it comes in a little bit cheaper some days. 7% rate for this one, 3.125 discount points in cost, puts a final APR at 7.38. So a good option compared to conventional, which the first true conventional option here is FHLMC, stands for Freddie Mac. So this option is 6.99 rate for a 3.375 discount points in cost, put the final APR at 7.396. So this is the first true conventional. If the rates go down a little bit more, I expect this to come back to the top and the portfolio option to go back down. But today, portfolio option, a touch cheaper because it doesn't need the loan level price adjustments that are required for the conventional options. So I would definitely recommend our customers check both of these out, but also compare to our non-QM. So for our final example, we'll do investment property again. And this time we'll select expanded guidelines, also known as non-QM. So the first thing we need to select here is our income type. The most popular income type for an investment property under non-QM is the DSCR option. That's our most popular loan as well. That's because it doesn't require any income or employment info from our borrower. Simply use the estimated income from the appraisal, the estimated rental income, to determine a DSCR value. It stands for debt service coverage ratio. The estimated rents can cover the expenses, aka the property will cash flow. That's a ratio of 1 or higher. We have options for ratios under 1, but for the demo we'll put 1.5 so we can see all the most common options pop up. And prepayment penalty is standard. We'll select 3 years for the demo. We can select 0, which will limit the programs and cost more. We can also select 5, which does limit the programs, but does save some money. 3 years is standard. That's what we'll use for our demo, as we do every day. So DSCR rates, wow. Couple options, absolutely smoking, and smoking conventional here. At the top, 6.75 rate, 3.4 discount points at cost. Put the final APR at 7.256. Smoking conventional, smoking the portfolio, full doc option. 100% of investors would use this program compared to conventional when it's cheaper and even when it's more expensive. So definitely recommend all of our investors check out the DSCR. All of our loan officers out there, send those DSCR quotes. This is the best option at the moment for a scenario such as this. Now, if we scroll down, there's hundreds of variations. Some of these DSCR options at higher rates and costs may allow bankruptcies, foreclosures, may allow short-term rental income. We did an episode on that earlier. May allow different property types. We've done a bunch of different episodes on that. And even this week, we did an episode on seasoning. Some of these may allow different seasoning, which is kind of our topic for today. So let me switch my screen and we'll go into Jose's deep dive topic, which is going to be fix and flip loans. So a lot of times when our investors come to us looking for a loan, they have a property that may have condition issues, right? So DSCR is great if the property is already rented, already rocking and rolling, no condition issues, no permitting issues, no compliance type of issues that often come up with properties. If there are, unfortunately, we can't do a standard long-term DSCR until those issues are cured. That's where the fix and flip loan comes in. So of course there's fix and flip always, but sometimes those properties that are good deals, we have to execute a small rehab in order to then do the end loan of DSCR. So we're able to do the DSCRs on their quick price, right? That's for a standard property once it's done. Now here's the harder part. How do we deal with a property that may not quite be ready for a standard DSCR loan for our investors? So Jose, how do our investors fix their property before they flip it or before they hold it into a long-term DSCR? That's going to be our topic for today. So go ahead and take it away.
All right. Good morning, everybody. This is one of our favorite loan products because it works hand in hand with our flagship DSCR product, because we just love empowering the borrowers, our investor flippers out there. And before I get too deep into this, let me also state one real valuable intrinsic value of the fix flip program. The fix flip program protects the borrower's credit scores so that they can continue to obtain all of those good end loans, the DSCR loan, right? When the exit strategy here is what you have to consider. So Nick touched on it. Surface level, the fix flip is used to, renovate properties that are, for a purchase, for example, that have condition related issues that you would not be able to purchase and close on with regular financing, right? That's the obvious there. We can go as high as 90% loan to value on the initial distribution. In other words, the purchase part of the loan with a borrower with heavy experience, flipping experience in the last 3 years. And 100% financing on the rehab. So best case scenario, a flipper can get one of these properties with 10% down on the purchase price and finance 100% of the renovation. But getting a little deeper, I can't stress enough the value of this loan in managing the investor's credit score, protecting their credit score so that they can continue to borrow all of those DSCR loans, right? The exit strategy, again, we're going back to the exit strategy. Most important when consulting your flipper on this process is the exit strategy. We cover this in our fix flip training, right? You got to be able to close on the purchase, right? But you also got to be able to exit out of that fix flip loan either by selling the property or, as is very common right now because the rental incomes are so high, refinancing that property into a DSCR loan. And in order to be able to do that successfully, you got to have as high of a credit score as possible to get the best terms, right? That, if you want that 80% cash out DSCR with no seasoning, which we offer very proudly at the Mortgage Calculator, you need at least a 720 credit score. And if you used your credit cards, as is sometimes we find the flippers that come to do a refi on a flip, they're halfway through, they run out of money because they thought they could do it with their credit cards, right? They didn't, why get a loan? I'm just going to use my credit card for this and that. Next thing you know, they're halfway through the project. Credit cards are maxed out over the limit. Their credit score is 600. And now what do they do? Or let's say even worse, the credit scores are 590. Now what do they do? I don't think there's too many fixed flip options below a 600. Definitely not going to get the best terms if you do find anything. So moral of the story is, do not use your credit cards to do the flip, right? Get this amazing fixed flip financing. Rates are a little bit higher, but definitely lower than credit card interest rates. A little bit higher than your fully amortizing 30-year end loan. But remember, all you're paying is interest, and you're only paying it for the time that you're using the loan. So the faster you get out of the flip, the faster you stop paying that interest and go into your end loan. So I wanted to throw this out there because that's a hidden value there that most loan consultants don't consider when empowering their borrower, but certainly one that we see that's very important for the flippers that don't heed the advice, use their credit cards, and now we're trying to help them out. Maybe they did finish the flip, but now their credit's 620, 610. I mean, what loan to value are you going to get on a DSCR loan with that kind of score? You're probably going to get 65, maybe if you're lucky, 70% LTV, but certainly not the no seasoning option that we're looking for at a 75 or an 80% LTV. So let me share my examples with you today. I got some good purchase examples, and then I got a little gem at the end for you here. So this is for our flipper with zero experience in the last 3 years. Let me try to make this a little bigger for you. Okay. Zero experience in the last 3 years, right? We got a few of those. Hey, I want to get into it. What can I do? Well, if you have good credit, you will get an option with zero flip experience in the last 3 years. At that point, it's credit-based and, most importantly, income-based. But what am I talking about income here? Remember, the income on any flip is not the borrower's personal income. The income on any flip is the ROI, the return on investment on the deal, aka the profit. What is the profit that deal is making? That's your return on investment. That's the litmus test on a flip. So first and foremost, what's the profit on the deal? Secondly, borrower's experience level. Thirdly, credit score, because credit score does definitely come into play. Like in this scenario here with zero flips, but a 760 credit on this flip that's making approximately 30% ROI, the maximum we're going to get loan to value on the initial distribution on the purchase portion is 75%. So in this scenario, we have a purchase price of $200,000 on the as-is portion, right? Whatever you're buying worth 200 grand, that's what you're paying. At closing, the initial distribution will be $150,000. You're going to have to give $50,000 down payment on the purchase, but our $100,000 rehab budget is 100% financed, right? So 25% down at closing, but 100% of the $100,000 rehab is financed for a total loan amount of $250,000, right? And we're looking at ROI on this deal, actually 24.63%, but they're still giving us the money because the credit is excellent. Rates a little bit higher. Excuse me. we're looking at 11.49%. And then look at this interesting number here, loan to cost, right? 82.92%. That's pretty impressive. So, and in this deal, estimated profit margin, $98,505 is the estimated profit, excuse me. So, and that's interest only payment, which you can finance up to 6 months of that into this 12-month loan. So this is for our flipper with 0 flips in the last 3 years. We get a lot of those, right? I mean, we get a lot of new flippers, and that's awesome because we have options for them. But remember, there'll be an adjustment in the initial distribution and the rate. And let me show you how that is affected, because now, same deal, everything is the same, credit, everything. The only thing I changed in this scenario was the experience level, right? This is why I want you all to see the experience levels, because you need to put this into context. Because when you are consulting your flippers, you need to properly explain the process and how their experience level comes into play. If they got a lot of experience level, it's obviously going to pump them up. Awesome. If they don't have a lot of experience level, at least you're going to put things in the correct context so that the proper expectations are formulated by the borrower, right? So here, 3+ flips in the last 3 years. Notice that our initial advance on this same deal now increases from $150,000 to $170,000, and our loan to value on the initial distribution, right, the initial purchase of the asset, increases to 85%. So now on that $200,000 purchase of this dilapidated property that they're gonna polish it and turn that coal into diamond, our loan to value now increases to 85%. So our 3+ experience flipper with a 760+ credit score on this deal, making roughly 25% ROI, is going to get 85% financing of the initial distribution, 100% financing of the $100,000 budget, maximum loan amount of $270 because of the extra $20,000 that they're getting at the closing, at the initial closing. So again, right, $200,000 purchase of the asset, $30,000 down payment. Our ARV is $400,000. We have the same ROI, 24.63, the same gross profit, 98,505. But I want you to see here, visualize how the extra flip experience helps our loan to cost. Now we're at 89.55% loan to cost, and notice that our ARV to LTV, or after repaired value to LTV, is 67.5%. Because depending on your ARV and your LTC, that the maximum ARV LTV may be the limiting factor on your loan amount as well, right? If your ARV is a little bit lower, you're not going to get the same loan amount. That definitely comes into play. It's ROI, ARV, LTV, LTC, different numbers control. But also, due to our greater experience, we not only get 10% more LTV on the initial distribution, but our rate drops to 10.49. So our rate drops by a whole 1%, and our loan amount increases. Win-win situation for our flipper with 3+ flips in the last 3 years. So carrying this scenario further, excuse me, now we got the flipper with 5+ flips in the last 3 years. Same scenario. You will note our initial advance remains the same, $170,000. We're still at 85% maximum LTV on the initial distribution, but our rate drops to 10.25%, right? So our rate does drop another 0.25% with the higher experience level. Everything else remains the same, right? All the other numbers are all the same. ARV, LTV, the loan to cost percentage, except that my rate now drops to 10.24%. everything else equal, they still got to come up with 15% down at the closing of the asset. So now, my last purchase example here is we have 10 plus flips in the last 3 years. Now, this is a best case scenario. Rate remains the same. 10.25 is our base rate with this conduit. That's the lowest we're going to get. However, we get 90% LTV on the initial distribution. That's the unicorn for the flippers, right? So this same flipper then is going to go into the 80% cash out refi, and he's going to be totally self-actualized as an investor flipper, right? Here, 10% down only. That's amazing. So $200,000 purchase price, he gives 20 grand down, and that's it. 100% financing of the rehab, maximum loan amount $280,000. You can see right here, nice big numbers, only 20 grand, everything else the same, right? ROI, profit. But now notice our ARV LTV is at 70%. We'd have to see what our limit is there, but 70%, we're still good. And loan to cost, look at that, 92.87% of the project is being financed, because the cost is the cost. They're getting financed 92.87%. So that's pretty impressive. So now in our last scenario here, we have a delayed financing option. Now, this is for a flipper with 3 plus flips in the last 3 years. Now, what is a delayed financing option? This is very common in the flipping world. They bought the property cash, right? They were in a hurry. They couldn't wait. It was the deal of the century. You couldn't even wait. Now, we have fixed flip options that don't even require a full appraisal, right? They do a desktop appraisal in-house. So for your really strong properties that you don't feel you need any little extra push from an appraiser actually going out there and saying how beautiful and how great the project is, for the really strong projects, we do have the option with no appraisal. We can close that in probably 7 or 8 days. That's fast, right? But in some cases, it's the deal of the century. They can't wait. They got to buy it cash. Then here we are giving them their money back, because delayed financing up to 6 months from the cash purchase, as long as that cash came from the borrower, directly traced back to the borrower, either their entity that they're owner of or them personally as an individual, you can do a delayed financing refinance to allow you to recover your money, right? So in this case, they want their money back, what they put down and everything, and they get back 85% on the initial distribution at the closing, right? So what that means is that at the closing table on this delayed financing refinance, the borrower gets $170,000 cash back, right? So he paid $200,000 for it. He's going to get $170,000 back. And the beautiful part right here, what's going to save their credit score, allow them to get that DSCR loan now to close, 100% of that $100,000 rehab budget is financed. So this is like such a win-win situation for this investor, that he gets his cash back, almost all of it. He paid 200, he gets back 170 grand. So he's only 30 grand in the hole there for the deal, plus $100,000 of the budget. So he got that asset for $30,000 out of pocket. And then when we refinance it at an 80%, assuming it's going to be worth $400,000, that's $320,000. He's going to get another $50,000. So he's going to get his $30,000 back plus another 20, and he has an asset that he's going to rent out for, $2,800 to $3,500 a month, whatever the rents are there where the property is. Total win-win situation. No credit cards used. Credit score remains 720, 740, whatever it is. A lot of these loans don't even report on their personal credit either. So, I mean, it's just all the benefits for the flipper here. Very few non-benefits that I see here. So amazing options here for our flippers. Want everybody to take into consideration the one intrinsic value I stated here. Protect your credit score. Don't use your credit cards. Use a fixed flip loans. Be able to get the DSCR loans and maintain your credit score high, and everybody's happy. So we see a couple questions here. Actually, we see one question here, which is
all right. It looks like we do have one question here. We can pull up on the screen.
Awesome. So, what is the minimum ROI for inexperienced investor with excellent credit? I would tell you that you're going to have to run that scenario through the pricing engines, because that's going to vary. It's really going to vary on experience. I mean, I can't tell you because there's no guideline for it. It's not set in stone. We run it through the pricing engine. Pricing engine evaluates the risk and gives you an answer. And usually, if you don't get the desired result, then you're going to have to play with the loan to value. In some cases, it just won't want it at all, and there's nothing you can do if the credit. But I've seen usually more like if the credit starts dropping below 700, and there's no experience, and the flip doesn't have a lot of ROI, it may not take it. So credit score does come into play, as does ROI. All I can suggest there is run it through the different scenarios and see. The ones that I just right now were low on the ROI really for a flip. I mean, 24, 25% is really low. In some cases, they really want 30 or 35%. So it really depends on the conduit that is being selected. That's why we have so many options. And that's why we don't assume anything. If it doesn't work on one, we go try another, and then we try another, and then we try another until we get the desired result, or as close to the desired result as possible. And then we empower the borrower by explaining everything clearly to them so that they don't have any unrealistic expectations.
All right. I don't see any other questions, so let's go ahead and wrap it up here. Remember, 11 a.m. Eastern time every weekday, we do this show where we have the live rates, and then we do a deep dive into a different topic. We'll be back tomorrow with a new topic. We appreciate everybody tuning in. Thank you for the comments. Thank you for the presentation, Jose. We'll see everybody tomorrow, 11 a.m. Eastern, for the next episode of Daily Rates Live with the Mortgage Calculator. Have a good day, everyone.
Thanks, everybody.